tell the audience about how you got started in real estate.
Welcome to the Masters in Real Estate podcast with your host, Tanner Webster.
For coming on. It's a pleasure to have you.
Good to be here.
So you started off like every, local Utah successful person at Ivory Homes. So let's talk a little bit about your time at Ivory, getting started.
I actually started on sales side. So I was a sales agent, sitting models for Clark and the Ivory team. It was a great way to just get started and start to learn the industry and just really open my eyes up to the home building space and development in general. They did all their own land dev too, so it's just fun to see that organization, and met Colin Wright there. Colin and I got to be friends while we were there, and
Colin Wright from CW Urban, friend of the show.
So we ended up leaving at the same time to go to graduate school, and Colin went to Columbia and I went to USC in LA, and that was where things started. So I got my MRED at SC, and then interned for Fieldstone Homes in Orange County while I was in school, and then took a job with a developer out of Newport Beach and worked for them for about 4 years. Opened up a division in Las Vegas for them when things were booming in 2004, and stayed with them for 4 years, managing the development of a 24-story condo tower again during the boom days. And so was there during the run up and during the collapse. So it was interesting times in Vegas.
Let's talk about the run up in Vegas, and just, was it all just like a light switch when that kind of stopped, or how did that stop in Vegas?
I wouldn't say it was a light switch. It started to slow in 2007. Our sales slowed on that condo tower, and our traffic slowed. And then, summer of 2007, you started to have the mortgage industry having some big issues, and a lot of different loan programs were going away that affected some of our buyers that were buying condos in our tower. And so there were definitely signs that the market was changing. There was, it wasn't the insatiable demand that there was through 2006 and into early 2007. It definitely started cooling, I would say, in summer of 2007. And then by, year end, it was pretty scary. And then 2008, everyone knows the whole bottom fell out. So wasn't a light switch. You could, if you had projects and you were touching and feeling traffic and absorption, it was definitely slowing in 2007.
Do you think after your experience with the condo tower kind of not going well, will you ever do condos again? Or is it?
We finance condos, but I would never do a tower again.
What's the reasoning?
I think your risk goes up tremendously on your construction timelines and just the construction costs of a tower, right? You got a lot of steel. It's your most expensive cost when you go that high, and you have no ability to be nimble, right? Like, you're pregnant with that project, the way it's designed for the market you designed it for. And if that market moves on you and you're building a 24-story tower like we were, that's not a fast project to get to market. And so your risk just goes up, and really good chance you're going to be delivering in a different market cycle than you designed for. And if you have a patient capital stack and you're in it for the long run, then that's okay. But selling condos, it's dependent on, the ability to get a mortgage. And that was probably the worst time in the last 50 years to get a mortgage, was in 2008.
Yeah.
We were fortunate enough we had big deposit requirements, 20% deposit requirements. So it was painful deposit to walk from. It was a 10% at contract and another 10% at groundbreaking. And so we closed, I think off memory, we had 126 contracts, and I think we converted 108 of them.
Oh, wow.
It was pretty remarkable to do that summer and fall of 2007. But the main reason was how meaty those deposits were, and people didn't want to walk from those.
Is Nevada one of those states where you can use like the buyer's
You cannot.
Yeah.
Utah's a state you can, but Nevada you
really?
cannot. So we had to escrow those dollars. So it was only released to us as the developer, as a seller, once we delivered the unit with C of O.
Okay.
But you cannot use, in Nevada, you cannot use deposit dollars towards construction. And we had hefty, I mean, that would have been a big,
That would have been nice.
meaningful piece of our equity
Yeah.
requirement had we been able to use that, but we were not. But that was it was an interesting learning experience. And in short, towers scare me because of how long the construction time frame is, how expensive the construction product type is, and the fact that you can't tweak anything in the next quote unquote phase. There is no next phase. It's all there. Whereas I compare it to a townhome project where, that was a 168 unit condo tower. If you're delivering 168 units, of townhome, obviously it's far less dense, but it's stick frame. And if the market moves on you after 80 units, you can adjust the floor plans on the next phase. You could pivot and go to for sale or for rent on the next phase. Not that you couldn't do that in a tower with mixed sales and leases, but it's just, you have the ability to tweak the product if you're developing in a less dense product type.
Mm-hmm. So that all happens in Vegas. And then what's your next move from there?
Yeah. So from there, it was an interesting time of life. There weren't a lot of job opportunities in real estate, and I landed on my feet doing loan workouts. So, again, Vegas was the epicenter of the downturn, or at least one of, right? There were a lot of markets hit hard. Vegas was one of those markets hit really hard. And with that created opportunity to work with lenders that were foreclosing on partially built, broken projects. And Vegas had a lot of condo towers and medium density condo projects going on. And I was just scrappy and proactive and was able to network into a handful of lenders that were taking deals back, and landed some consulting gigs, just helping them manage the process, whether it was more on the financial feasibility side to consider different product types, extended stay hotel, apartment, etc. We were kind of running numbers on various uses because the condo exit just wasn't there, right? There weren't buyers, there wasn't financing. It was a falling knife. The bottom hadn't hit yet. No one knew where the bottom was. And so it was just a real tricky time to determine what was the best exit when the condo market had gone away for that time, and in some people's mind for the foreseeable future. So yeah, that's how I landed on my feet, was doing loan workouts, which was a really good experience, to go from the development side of things and then work directly with lenders as my client that had taken projects back from their borrowers. And I was stepping in to help them get the projects over the finish line, working with their contractors, as well as working with them directly on potential different uses that might be more feasible than the track that they were on.
Where did you see most of those uses going? Were they mostly going to rent, or like?
Most of it was to rent, but we had one project in particular that the numbers looked pretty good. It was a mid-rise condo project with really strong amenities. It's parked well, and we strongly considered extended stay hotel. And that one, they didn't make the final decision on what route they were going to go, and I took a full-time gig with one of my other clients, so I honestly don't know on that particular one, but it was mostly for rent, right? You don't have to change the product type for that, right? And they were spec'd higher than what traditional for rent product was back in 2008, but that was an easy, logical way to at least tread water and get some cash flow coming in on an asset that these now owners / lenders had a lot of capital tied up in.
Yep. So you're doing those loan workouts, and then at what point did you decide, I want to go do this on my own?
So there's another stop in that gig. So one of my clients was a private lender. They were a REIT and had about a $600 million portfolio. And so they were one of a handful of clients that I was consulting for. and they put together an offer to bring me in-house to be their senior vice president over originations and loan workouts, and basically just manage through their portfolio. They had all but one loan in default, so it was a bit of a train wreck.
Yeah.
And so that I stayed there almost 3 years, and that was again a very eye-opening experience where just everything you can imagine going wrong on a loan went wrong. And again, part of it was the market. I'll say part of it was poor underwriting on the front end. And there were deals that, yeah, I won't go into all the details, but there were a lot of deals that had a lot of problems with them, and some of that was with poor management on the construction draw process. Some of it was just deals that shouldn't have been originated on the front end. Some of it was good deals going in, and then the market changed abruptly, and it was a national footprint, but they were pretty heavy in Vegas. And this is a generic statement, but in general, kind of peak to trough in Vegas during that era, you were down about 50% on value, right? So
Tough to make money.
Yeah, in that situation. But that was a really eye-opening experience on the lending side. I had never envisioned myself making a career on the lending side. I used to kind of joke that lenders weren't in the game, it was boring.
That's what I say.
Yeah,
so, yeah.
Get in the game, right?
Yeah.
Go develop something, go create something. And honestly, just seeing the aftermath of the '08 downturn and seeing super successful developers left with nothing, and then landing and surviving myself, just kind of utilizing my skill set doing loan workouts, it opened my eyes to, from a risk reward standpoint, the debt side became more intriguing to me after just seeing the exposure and the downfall, and people I really respected in the industry that had been super successful and had really strong net worth that now is a negative net worth almost overnight, caused me to pause a little bit. And then as I just out of survival was working on the loan workout side and the lending side, I learned the lending side, and it opened my eyes to the opportunities in the lending sector. And had two good friends at that shop with me that I recruited to come join me, Mark Taylor and Andrew Menlove, and the three of us worked through that portfolio. And every now and then, we'd find ourselves at lunch brainstorming, doing it on our own, and felt like we could do it better than that particular firm, and realized they weren't any smarter than us. In fact, we thought we were a little smarter than them.
Of course.
And so, we talked about going out on our own, but it was a tough time to go out on your own. This was now in 2010, so been there, 2.5 years or so, but it still wasn't a rosy real estate environment out there. Felt like things had hit bottom and we were kind of stabilizing in 2010, but the capital markets were still, not back to normal. And it was just kind of felt grateful to have a good job. Yeah. Right. So I didn't feel like it was the best time to go out. And then got a little kick out the door with myself, and there was 13 of us that were laid off.
Laid off because the economy was so good.
Yeah, the economy hadn't got better as quick as the firm had hoped. And we'd made a lot of progress on their loan workouts, and we had started originations up again, but nowhere near kind of the fundraising and the jump start wasn't at the level they had projected it would be. So I think they were hanging on as long as they could, and the loan workouts and the damage done on their portfolio that we were unwinding was more damage than expected, I think. And it was just a deep correction, right? And so, yeah, they couldn't keep the lights on with the team as they had it built. And so they let 3 of their 4 senior vice presidents go, and I was in that mix. And at the time, it was super scary and really a surprise. But at the end of the day, it was a massive blessing in disguise, because it gave me that motivation where once I had that news, I determined I'd never work for someone else again. I felt like my livelihood was in their hands. And I'd just given them 3 years of really hard work and helped that portfolio, although it took big hits because of what the market had done. I felt like the team I had built and what we had done had really salvaged a lot of the damage. And so to get that news was a painful pill, but at the end of the day, it was just a massive blessing in disguise, because at that moment, decided I was going to go out on my own. And then Mark Taylor did a Mark Taylor move. And anyone who's listening that knows Mark Taylor, they'll appreciate this. But Mark followed me out the door a couple weeks later.
That's so cool.
Yeah. And, we'd been talking about doing it for a year, but neither of us felt like it was the right time. And I mean, Mark had a rare lung disease. Mark had health issues. If anyone had excuses of why it was not the right time to start a company and to bail on a good salary and a well-paying job, it was Mark. But yeah, he followed me out, and we brainstormed Taylor Derrick Capital and the right structure, and launched our first fund about 6 months later.
How'd you launch that first fund? Were you passing the hat to your richest friends and family, or was it all out of your pocket, or how did that work?
My pocket wasn't very deep at that time, so that would have been the easy way to do it.
Woman's pants with small pockets.
Yeah, I had baby number 4 on the way, and a mortgage on a house in Vegas that was now substantially upside down in value. Had a handful of real estate investments, in Utah and Idaho, nothing big, but enough to stress me out. And so, yeah, honestly, I had a negative net worth at the time. I was worth less than zero.
This is awesome.
So it was a pretty stressful time financially for me. And after, and so I had enough savings to just kind of survive for a little bit. But I actually had to started landing some consulting gigs with some big institutional groups that were taking down some of the bank portfolios that were going out to auction in that era, late 2010, early 2011. So I underwrote like 7 of those large transactions, and those were kind of like 3 to 4 month consulting gigs, and I just burned the midnight oil. And Mark was cool with it because he knew I needed that income. Mark had a little bit more cash, so he was able to kind of seed the startup costs. The legal costs were big to launch the fund properly and to do things the right way, and just, office space, even though we didn't need much, we needed something, but we weren't paying ourselves. We weren't making any money, and it was a stressful time. But back to your, how do we raise the money? Neither of us had enough. Mark had enough to kind of get the business off the ground, and he put a little bit in early on, but we had 8 investors that basically each put in like $100,000, and we launched the fund with $800,000 in March of 2011. And, that's enough to do a couple one-off home construction loans, right? So not a real diverse portfolio, but it was a start.
Yeah. So I can't imagine the fees are very high on that. So is it more just like, we're going to build a track record and like, this is going to get bigger? Like, how did you grow from there?
It was all about building a track record, and actually even taking a step back. It's the chicken and the egg, right? You need the money, but you also need the borrower. And so to launch a fund, it's a little bit more cumbersome. And so to prime the pump per se, we had a little, an entity called TD Lending that, just standing for Taylor and Derrick for TD. So TD Lending was like our pump primer. And we were doing some one-off construction loans through TD Lending to Henry Walker Homes. Mm-hmm. So again, Colin Wright, buddy of ours, he had launched a home builder, and they had a handful of lenders, and we were one small lender doing just a handful. I think we had like 5 or 6 construction loans out with him through TD Lending, and we had raised some one-off capital for each of those loans. A little bit easier to raise money for a one-off deal than a fund. Mm-hmm. And the hope was that some of those investors would have interest in then rolling into the fund, which would be a little stickier commitment where we'd be doing multiple loans inside of the fund, and their redemption would come through a more, complicated process of redeeming from the fund versus just waiting for that one-off loan to pay off, right? So there, we started there so we could prove the concept a little bit. And so we had a handful of construction loans we could point to. We had our track record with our loan workouts and our previous development experience. Mark also had development experience, condo conversions, and some other projects he was involved in. And so, we had a background in the industry, but it was our first fund, and it was not an easy environment to raise money. So we were scrappy, we were proactive, and we were really focused on structuring a fund that not only had a good business plan, but also had splits and a structure that was super fair to our investors.
Can we talk about that? Like how the fund, was it, I'll let you describe the terms and that type of stuff, but kind of the thought process behind it as well.
Yeah, so we just, researched out what other fund structures were and like the typical hedge fund structure in real estate or even in private equity and other funds was a 2 and 20 fund where the GP, the fund manager, was earning a 2% management fee on dollars invested and getting 20% of the upside, and their investors are getting 80% of the upside. So that was a pretty vanilla down the middle. Obviously, there's tweaks going both directions, but that was industry standard, and I'd say even today is still, relatively close to industry standard. And so we just left a little bit more upside for the investors with it being our first fund. Wanted to, especially the experience we had from that shop we'd been at. We didn't feel like the investors were always treated the way maybe they could have been or should have been. And so we came out of that with the view that we wanted to take care of our investors, put our investors first. And so we did an 85-15 structure, so left a little more upside for the investors and wanted to create a track record and, philosophically felt like we'd rather have a smaller piece of what could become a bigger pie than going the other direction, maybe being a little greedy on the GP side and not successfully raising as much money. And that philosophy worked out well for us. It was the hardest dollars to raise were that first year. I think we ended our first year at 2.9 million.
That's pretty good though.
Yeah.
I think so.
Yeah, we were happy with it. We were proud of it. I remember Mark and I did a year-end retreat at his parents' place in St. George and kind of celebrated the end of our first year, and that we were live. We were going. We had big goals for the next year. I think we ended the next year at 13 million and then 25 million and then 50, and kind of just, had good snowball growth. And it got a little easier once we had a track record and it proved the concept and we're delivering returns to our investors. And even when we were a $2.9 million fund, we were audited, right? So we acted like we were bigger than we were because we wanted to be transparent and be able to prove that our returns were what they were. It wasn't just us. It wasn't hearsay. It wasn't us just quoting numbers. So we always wanted to be able to point to what the fund had actually done and to prove that out. So the fund's been audited since year one, and that was our start. Those were our early days.
So you talked about the chicken and the egg problem. I find this hard with like for me, like trying to find good deals, but also having the money behind me. And you kind of have a similar product, but you need the money, and then you also need the borrowers. Were either of those harder than the other?
For sure, because in 2011 when we launched this thing, banks weren't really lending, right? The pendulum, the real estate downturn in part was caused by too much cash flowing into deals that never should have been capitalized, right? So not just the banks, but kind of all sources of capital were flowing into real estate too freely. And then in the banking industry, that pendulum swung too far the other direction, with Dodd-Frank and Basel III and all of the regulations that got strapped onto the real estate, lending environment. And so it became very difficult to borrow from a bank in that era. It was really cash intensive, and they just weren't doing near the volume or transactions that they were previously, nor should they have. But the pendulum likely swung too far, and that's what created this opportunity in the private lending space. So what I'm getting at is there was a tremendous amount of demand from the borrowers because there was limited capital sources. And mind you, in 2011, there were still distressed deals going on, right? People were still buying up deals at significant discounts and getting in at a great basis. And so their biggest issue was capital. And a lot of borrowers were licking their wounds from deals gone bad. And so if you had investors or developers that didn't have some of that baggage and some of the issues that the downturn created, and they were coming in fresh, their biggest constraint was capital. So by far and away, our hardest piece of that chicken and egg puzzle was definitely the investor side. Being a fund without a track record and our first fund, that was a bit of a hill to climb. But I think we both had good personal reputations with those we'd worked with in the past. And it's not like we were trying to do this at 25, right? I was 35, Mark was 38. We'd been in the industry for a fair amount of time, decade plus, both of us. So with that, opportunity presented itself and we took a shot.
And these were all first position construction loans. Were they all houses or what were they?
Yeah, they were all first position construction loans. Our docs are set up that we can do up to 20% of the fund in second position, but historically we've always, been 90+% in first position. And in the early days, it was predominantly one-off construction loans for medium to small size home builders.
Mm-hmm.
And then, we eventually started doing some commercial loans as well and evolved. We always had the vision that the fund would be diversified across residential and commercial. But on the residential side, we were never working with like end users. It was always with a builder. And that was the origin, was really small home builders.
Okay. And when you said you can do like 20% of the fund in a second position. Is that debt and equity, or are those two separate vehicles, or how does that work?
We can do both. We only did one true kind of equity venture in the fund, and we had to sidecar that. And it's just in a closed end fund, it's tricky. In an open end fund, which is what our debt fund is, it's tricky to do equity because you need a mark to market. And again, our investors can come in and come out of the vehicle. It's not a closed end fund where all the investors are in and until the end. And that's why, in my opinion, equity is a cleaner fit for a closed end fund. So we did this one particular deal, but we sidecarred it. So it was just the LPs that were in the fund at that point in time. And we actually went out and gave them all a vote to opt in or opt out, even though the docs allowed us to do it. We were a debt fund, and that's what we had, marketed ourselves as to our LPs. And so even though the docs let us do up to 20%, which this was in, we still went out and got a vote and let people opt in or out into this particular deal we did equity in. That was the only deal we did a true equity kind of LP position in the fund, just because the accounting is complicated.
Yeah.
Sidecarring it allowed us to do that in a less complicated way. But after that, we just decided to do equity funds for the equity investments we've wanted to do. So we've done 10 different equity funds over the last decade to do one-off equity investments, and a handful of those funds were a little bit larger, where we invested in a portfolio and a strategy.
Okay. I want to talk about a little bit more about that structure. You've told me before that you're structured as a REIT, which is super interesting to me just because I'm not familiar with open-ended funds as much as I am closed-end vehicles, just because I've never done it before. Was that always the plan, or how did that evolve, like the fund going from funds to the open-ended vehicle?
So the debt fund was always an open-ended vehicle.
Okay.
So evergreen fund is what it's called, and that's how we set it up out of the gates. And the philosophy for us is we didn't want to launch a debt fund that was like a 2 or 3 or 5 year venture. We were launching a fund that we wanted to turn into an ongoing business, where we envisioned, payoffs turning around into new originations and long-term borrower relationships. We didn't want to be one of the old school hard money lenders that was just transactional and kind of, I'll say, loan to own, right? Just focused on fees and the transaction. We were much more focused on the relationship. And so we just felt like an open-ended fund that we could turn into a lending platform was what was intriguing to us, and we felt like would be intriguing to the borrowers as well as to the investors, because it was relationships and a platform they were investing in, not just a one-off deal.
Mm-hmm.
So we wanted to bring that diversification, and the fund structure. If it were a closed-end fund, it would have an end date where that would all go away. And so, again, the goal was to create a vehicle that would allow us to build a business, build a lending debt platform, and the Evergreen Fund was a better fit for that. And then it was not a REIT out of the gates. It was just a limited partnership. And then in 2017, there were some tax changes where it made sense for us to create a wholly owned subsidiary REIT where the loans are now held in a REIT. And so that, from a tax structure for our investors, allows us to pay distributions as a dividend instead of ordinary income. And dividend income is taxed more favorably than ordinary income.
Okay. So. This might be a kind of a dumb question, but you've got, let's say you have a loan portfolio or a loan, just a fund of like 100 million in this format. How much do you have out in a time in originations? Like, how much do you keep in reserves? Like, how does that even really work?
Yeah, that's a balance for sure. One of the biggest balances, that I think a construction fund manager juggles. That's why a lot of funds don't do construction loans, right? Those do bridge loans because they'll place all the capital and it's out until it pay off. There's pros and cons because then your pay downs are really chunky. But on the construction side, you draw in to loans. And so you've got loans drawing in, you've got loans paying down, you've got new investors coming in, you've got some
investors. It sounds so complicated.
Yeah. And so there are multiple buckets, and that's a big piece of what we manage as a fund manager. And one of the ways that we manage kind of the ebbs and flows of those swings is we do have a bank line of credit that works really well to smooth out those peaks and valleys.
Okay. How do you use that? Is it strictly to smooth out like the capital calls or like that type of thing? Or are you adding leverage to these funds, to these draws?
Yeah. So we don't have a line of credit tied to our equity funds, just our debt fund.
Yeah.
And so it's not a capital call format in our debt fund.
Yep.
Yeah, so that in our equity funds we do capital calls, but in our debt fund, they commit the dollar amount that they're comfortable committing as long as it's above our minimum, and all of the money comes in at once, and then they own their pro rata share of the loan portfolio.
Okay.
We open and close the books every month in that fund, and so we do distributions every month, and we allow new investors to come in and some investors to go out, tied to us opening and closing those books. So, if that answers your question, the leverage is partly used for some arbitrage, right? Mm-hmm. We can borrow at a lower rate than we can lend it out at, so it does help slightly lift returns, but we're very lowly levered. So it's more the vehicle of smoothing out peaks and valleys of the loan needs for the fund, the loan commitments.
Man, you've got a complicated business, I gotta say.
People think, oh, debt's easy, right? I'm gonna do some lending on the side, but no, debt has its own complexities for sure.
Yeah.
And it's a great business. We love being a lender. It's not as sexy. It doesn't have as much upside, mm-hmm. but it doesn't have the same downside. So for our investor base and for us personally, we really like the kind of risk reward ratio that you get with debt. On an adjusted basis, we think debt's a great way to go.
So let's say someone's listening to this podcast and they say, I want to go get a construction loan from Derrick Capital. Walk me through how that would work, like what you're looking for from the sponsor, the deal itself. How does that work?
Great question. Well, I'd say starts with footprint. We're not a national lender, so we're active in the Western U.S. and in particular the Mountain West states. So the states we're most active in is Utah, Arizona, Colorado, Nevada, Texas. Those are the states we're most active in. We're getting active again in Idaho, but we'll look at anything in the West. We shy away from the West Coast a bit, just because of the bureaucracy and difficulties that we see in some of those states. It just adds risk to the deals. So Mountain West states is number one. So it's got to be in our footprint. We're not trying to understand every market in the country. It's too difficult for us to underwrite markets we don't know. So we stick to the states that we know. And then I would say our borrowers, they're bank-worthy borrowers, and they're choosing to come to us for speed and flexibility and potentially some additional leverage than they're going to get from the bank. The nice thing about our debt fund is we're not a depository institution, right? I mean, a bank's going to lend you X amount of dollars, but they're also going to require X amount of dollars back in deposits.
It'd be kind of cool if you did that, though. Like, yeah, I'll lend you your own money if you want. So
yeah. we do have some borrowers that are also investors. So in essence, we do that on a small scale, and it's always cool when we can win someone's business on both sides of the table. It makes us feel like we're doing it right.
That's cool.
But in general, I would say our borrowers, they've got to have, experience. The asset itself's got to stand on its own two legs from just market demand and, budget and profit margin. So yeah, it's the borrower, it's the market, it's the asset. We are more of an asset-based lender, so we don't need an endless net worth, but they've got to have a commensurate net worth with what they're looking to borrow. Okay. And if they don't, we'll look for them to bring in some sort of a partner that beefs that up. So again, we're not loosey-goosey. As a private lender, we have pretty strong criteria, but we, for the right deals, can provide a fair amount more leverage than the bank. I mean, I'll give you an example. In today's environment, which is a tricky construction lending environment, right?
You could say so.
Right?
Yeah.
Definitely different than it was 2-3 years ago. And so in today's environment, the banks are getting hung up on their loans are limited to what the debt coverage ratio on a takeout loan can support. And with where rates are at today and where they have to stress those rates, the debt coverage ratios is kind of yielding back into sub 50% loan to cost loan amount. So, you've got the LTV, the LTC, and the debt coverage ratio. And debt coverage ratio never was the limiting factor on a loan when rates were 2, 3, 4%, right? You didn't even need a calc it. But today it's absolutely the governing factor on loans. And so it's limiting those LTV, LTCs to really low numbers, which creates a big opportunity for us because some of our deals are going to be taken out by a perm loan, and then that takeout loan and the DCRs are more of a factor. But a lot of our developers are borrowers are merchant developers, right? Their exit is to sell the asset. So obviously their margin's at risk, but we don't need to underwrite to a tight DCR. So in that sense, where the banks may be capping out at 45% LTC and the borrower's got to come in with 55% down for that particular deal, we might get comfortable with 70% LTC. And if there's enough margin in the deal, we typically are around a 65% LTV loan to value on the completed value of the asset on a construction loan. That varies, right? If it's spec versus pre-sale, there's a lot of factors where we might want to be low 60s or high 60s, or if it's a credit tenant, maybe we'll go into the low 70s. But in general, you look at that compared to maybe a 45 or a 47% LTC deal. Yes, the bank's cheaper and our borrowers are paying a premium for our debt, but if we're half the equity, cash is expensive. And if they're bringing that equity from a third party, joint venture equity partner, they're taking ownership in their deal, and that's just expensive. So it's just math, and it's also speed. Just time is money. And we are easier to work with. And so there's just a lot of reasons why we've been able to attract really good borrowers. So in essence, it's someone, that maybe is struggling to live with the liquidity covenants their bank's putting on them. They're struggling to stomach the deposit requirements that the bank is putting on them. And this speed is killing them, whereas they might be going through a 3 or 4 month underwriting commitment process with the bank, which is a little bit of a moving target because the credit committee is not ultimately who they're working directly with. In our shop, my partner, Nick Etherington, runs point on originations and underwriting. And, he and one of my other partners and I are the decision makers on the credit committee side. So our borrowers are dealing directly with decision makers from day one. So we can just be more fluid in the underwriting process. We can make decisions quicker. We can get them feedback quicker, and they'll pay a premium for all of that. The higher leverage, the speed, access to decision makers. And then I'd say on the back end, another thing that's attractive to some of our borrowers is if things don't go perfectly to plan, we tend to be pretty logical and solution oriented, and we try to, we consider ourselves a debt partner. Now, if the borrower is hiding the ball and doing things they shouldn't do and hurting the value of the loan, we're going to be tough. But if they're forthright and putting forth good effort and the market surprises them, or they get some sort of a budget bust that was maybe out of their control with some spike in material costs or what have you, we're going to try to be solution oriented and work with them. So that's attractive to our borrowers too.
So if they're not acting accordingly, do you foreclose or do you sell the note, or do you have a preference on that?
Foreclose.
Then you guys would just take care of it?
Yeah.
Cool.
Yeah. And when we foreclose, again, another thing that differentiates us, as a private fund, we don't have the regulations that a bank has. And so it doesn't hurt us per se to have an REO on our books. I mean, we look at everything through a yield perspective. So obviously we want performing loans. That's what's generating return and cash flow for our investors. And we're not underwriting to ever want to take an asset back. But if at the end of the day, to protect our investment, we need to take an asset back, we will foreclose. But we typically will kind of step into more of an owner mindset at that point, finish construction. If it's a for sale product, go through the sales process. If it's a lease up project, lease it up, stabilize it, and look to try to, again, protect value for us and our investors and exit when it makes sense. Whereas a traditional lender is typically going to fire sell the asset, take their lumps and move on. We're all about protecting the principal, even if we have to take a longer approach to do that.
You mentioned the yield perspective, like you're always looking at deals from the yield perspective. How do you underwrite like a loan offering? Are you looking, is it risk adjusted return, or is it just like you have a baseline of X percent APR? How does that really work?
Yeah, it's a good question. We definitely have a kind of a hurdle that if we can't get a certain rate, it's just not worth our while. Mm-hmm. And thankfully we have an overflow of deals, so we don't have to, push pricing down too much because there's more deals than there is capital. And, last year we saw over $12 billion in loan requests and we funded less than $500 million, so well below 5% of what we saw. So we can be picky, but yes, there is a threshold that if we can't get a certain yield, we're just not going to do the deal because we know there's 3 or 4 more deals that day that are coming across our desk.
Yep.
And we're going to find deals that we like that also meet our yield parameters. But it's not easy. Every deal that comes across doesn't have enough margin to support our rates. Every deal that comes across, the borrower doesn't have the resume that we want. And so, to check all of those boxes and still hit our yield hurdles, it takes a lot of work, and we've got a good process. We've got a good reputation. So we see a lot of deals. We've got a lot of repeat borrowers. Over 80% of our portfolio is repeat. So, but that didn't happen overnight, right? That's 13 years of running the fund in a disciplined way to attract our borrowers back to us because the way we work with them. But yeah, there absolutely is a yield threshold. There's a certain yield where it's just not worth our while, even if the risk drops, tremendously. We adjust our risk, with managing to good loan to values and working in markets that we're confident in and borrowers we're confident in. So we won't ever do a deal that we feel there's, significant risk to lose capital. That's just against our mantra. Mm-hmm. We're all about capital preservation first and yield second. But we're gonna get what the market will give us from a yield standpoint, if that makes sense. The market really sets that. Our competition sets that. But from a risk standpoint, we're just not going to do deals that we feel like puts our capital at a significant risk.
So let's talk about the equity offerings. Is this how much of the portfolio is equity versus debt? Sorry to put you on the spot right now.
No, yeah, our portfolio today is about $780 million. And roughly $600 million of that is in our debt platform. So okay. We are a debt shop, and that's what we, that's our bread and butter. It's what we do. It's our expertise. We're a short-term lender, both bridge lending and construction lending. And then I would say the debt platform drums up some unique equity opportunities through our borrower base. And so over the years, we've done, a fair amount of joint venture equity, and today it's about $180 million that we have out in different equity investments with our development partners, and again, that's really all relationship. It's really relationships that have been derived from our debt fund.
How do you look at the equity offerings versus the debt offerings? Are they like kind of similar, or like what? What's the difference on that?
Well, we're taking on more risk, obviously, being in an equity position. So we're key to disclose that and make sure our investor base understands is this is not our debt fund risk profile.
Mm-hmm.
And those are closed-end funds. So, and they vary. We've got some closed-end equity investment funds that were set up for long-term patient land deals, large commercial land deals, 1,500, 2,000 acre, 20-year deals, residential stuff in Arizona with the same development partner that have a deep relationship with. And it's, more of a land bank deal where probably be in that deal for, 15 to 20 years. And so we have some, that's not our norm, but we've got a couple deals that kind of fall into that longer term platform. And that's definitely not a fit for every investor. I'd say our normal equity fund is more of a 3 to 5 year play where we're teaming up with developers and we're capitalizing the equity needed with a co-invest from them to then, build out different assets, lease them up, stabilize them, sell them, or some of them are for sale. So they're just, it's just a merchant play out of the gates where we're selling. So 3 to 5 years is more of our typical equity horizon when we're looking at equity deals. In a fund, it's hard to structure a long-term hold structure. You can do that, but it's a little bit more difficult to raise that capital and structure inside of a fund and not have an exit. And so that 3 to 5 year window, kind of 7 years on the outside, is more our wheelhouse on our equity investments, with a couple of those exceptions I mentioned earlier on some more patient land deals where we set the expectations up front that those were going to be longer term holds, and we have a smaller investor count in those deals that had interest in that type of investment.
And are these all has every equity sponsor borrowed money from you on the debt side, or how does that work?
Typically, yes. We do have one sponsor who started as equity, and that's kind of the one exception I can think of. But ironically, I think we've done 3 or 4 equity investments with them, pretty significant deals, and they've since borrowed from us on a handful of occasions as well, bridge lending deals. So off the top of my head, I cannot think of an equity deal where we have not lent to them, but there was one that started as equity and then graduated to both. But our norm and all the others, aside from that one exception I can think of, they first were a borrower. And I like the analogy that we like to date somebody first.
Yeah.
And debt, just has more room for error because our borrower's equity is at risk, their margin's at risk. So again, we're typically sitting at like a 65% loan to value in first position. So a lot has to go wrong for us to lose money on that deal. Whereas when we're equity, we're going to take it on the chin, with our development partner, right? We are the owner, and equity comes with the upside, but it also comes with the downside. And so we like to take the risk of our development partner off the table, that we know they're a good operator. We know they're honest. We know they have integrity, and we're dealing with market risk, and, there's still execution risk. But if you know that borrower and that developer, because you've watched them execute multiple times from your debt platform, it definitely helps us go into an equity investment with eyes a little bit more wide open.
How do you look at risk on the equity side? Because I assume since you're putting up 90% of the equity, you're making the decisions on like financing, sell, that type of stuff. Are you like more aggressive on your financing? Like, are you telling them to get 70% loan in a normal credit environment, 70% from a bank, or 50% from a bank? How do you look at like those major decisions?
It all depends on the asset.
Mm-hmm.
I mean, we've got a dirt deal that we're equity in that we had a nominal amount of leverage on, that we've just decided with our development partner, we're going to retire all of that debt. So we're doing a capital call, and we want to make sure we're just in a position to be super patient. So honestly, it could go both ways. Other assets that are maybe pre-sold and we're very confident in the exit strategy, we're comfortable taking on a little bit more leverage. But even though we're a lender and that's our core business, we prefer being the lender than a borrower. So when we're on, if that makes sense, so when we're on the borrowing side, we don't want to undercapitalize the deal.
Yep.
Because we know firsthand that too much leverage, everyone knows this, that's in the industry. That's the first thing that can cause problems and tip over a deal. So I think we're prudent, and just try to have sufficient equity to make sure we have takeout options and staying power.
So 780 million is a lot of money, you could say. You don't have to name specifically who they are, but who are your typical investors? Are they high net worth? Are they friends and family? Are they pension funds, sovereign wealth funds? How does that look?
Yeah, good question. For the most part, it's high net worth individuals and family offices. And then we have a handful of fund of funds and some kind of smaller institutional investors, endowment funds, and so forth. So in the early days, it was just all high net worth. And our goal was, as soon as we had 2 years of audited financials, we were going to go try to attract institutional money. And when we went out and started having some of those meetings, 2-3 years into managing the fund, we realized pretty quick that institutional money came with a lot of strings attached. And we didn't want to work for someone again. And it felt a lot like that. We lost control. And so we ultimately decided we'd rather take the tortoise approach and just raise money slowly through our normal channels of high net worth and family offices, and didn't need to get $100 million checks. We were okay with the check sizes that came kind of 250 grand up to 5 million. I'd say was kind of our investor sizes in the earlier days, and then it's grown from there.
Yep.
To be where we've got family offices and some other fund of funds that have a substantial amount of capital with us. But we don't have one large institutional investor. In fact, we kind of have an unwritten rule internally that we don't want any investor that has more than 10% of our debt fund, just because we don't want to be beholden and give too much kind of leverage to any one LP. We like that diversified approach of having multiple LPs. And it's treated us well. There's pros and cons, right? I mean, one institutional investor with $500 million in your fund is a lot easier, to manage one investor than it is to manage over 500 investors. But you also have all your eggs in that basket. And if they decide they want to pivot and go in a different direction,
it's a partner boss.
Yeah, partner boss.
Yeah.
So we, it's a good structure. Again, I'm not saying it's the end all be all structure, but it's worked well for us, and it's evolved to where we have a very sophisticated investor base, and a lot of them have become friends, and we just work really hard to do right by them. And we as partners are all heavily invested in our funds, and we've just got great people that have, been privileged to have great people invest with us and become friends and be a part of it, and work hard to protect their money.
I feel like the last 2-3 years, like private credit has been where everybody wants to be. Has your phone just been like ringing off the hook, like we want to get in on these deals, or how difficult has fundraising been?
It's a really good question. There's no doubt that private credit has become much more popular. And you've got big institutional groups that have entered our space. And so you've got multi-billion dollar, debt funds that are in our space. We don't really compete with them. They do much larger loans, and those shops want their own fund, right? They're gonna run it the way they want to run it. Then you've got some, we're more of a middle market lender, and there's definitely been more interest, I would say, in smaller institutional investors that are comfortable where they don't need to be the sole investor. They're comfortable investing in other GPs platforms, when with us, we have a 10 plus year track record. So that has opened some doors for us. And I'd say our investor base has evolved. But ringing off the hook, no, we still have to be somewhat proactive, but we are fortunate enough to have a lot of growth just through existing investors adding capital, because they believe in the concept and they've seen what we've been able to do. And I think the downside protection that debt brings is good, right? But yeah, a lot of loyal investors that have continued to add, and we're always, we always welcome intros, which our investor base has been great about introducing us to those that they know. And we can't, we don't market generally the way our fund is structured and SEC regulations and so forth. So we have to have an existing relationship with someone that we allow to come into the fund. So we're not out soliciting or marketing. And so really the growth has come from existing investors introducing us, and then us just networking, meeting people, getting to know people. And we're not like real salesy. We want the proof to be in the pudding,
vibes.
So if it's a fit, if someone hears about us and they want to know, and it's a fit, great. Again, we've got to get to know you, period, that we have to live within. But we always want the investor to come in eyes wide open, and we want them to feel like it's a fit for them. We don't want them to get in and feel like, we sold them something that it's not. It's the last thing we ever want.
So what does the future of Taylor Derrick Capital look like? Like, I know a lot of other maybe non-traditional lenders get into like financing equipment or other additional asset classes. Where do you think you're going in that?
It's a great question. We're a real estate shop.
Yeah.
In the early days, we'd get calls all the time for business loans. And there's definitely a market in private credit in the business sector, but it's just not a skill set we have. We do have some competitors that do both, and I think they do both well. So could we add that someday down the road? Yeah, if we had, the right person that came with expertise in that field, but it's not on our horizon. We're a real estate shop. We prefer to lend on real estate and to invest in real estate because we believe in real estate. We like the hard asset there. And so I don't envision us venturing outside of real estate, even though there are a lot of private credit opportunities on other assets outside of real estate. You don't need to do everything, and kind of fall into the philosophy. I have a board member that has told us on multiple occasions, stick to your knitting, and I think that's good advice, and we try to stick to that. So do we still want to be opportunistic? Yes. Expand our debt platform, for market share? Yes. So what do I see us doing? I just see us growing our current platform. I don't see us venturing into new sectors, but there's massive opportunity growth for us. Some other private lenders, have gone away. Some over levered that created problems, over the last couple of years. Some are still alive and well, but there's just tremendous opportunity in the private credit real estate sector. And we've got a 13-year track record being in it and plan on being in it, for the long term. So we're just going to keep growing our platform. We don't need to do it all overnight. But I think we'll, take it to $1 billion platform over the next few years. And if we find that 800 million is the magic number and we're not finding good enough deals to grow it, we'll stop now in growth. But so far, the growth has just created more opportunities. And so where we see good opportunities, we'll continue to grow, but in a responsible way. We've got a great team. We've got a great bench. We've really invested in growing our team. We've got an office in Henderson, Nevada, and an office here, just north of downtown Salt Lake, and got great people at Taylor Derrick Capital, and it's a fun spot. We've got a great culture, and as long as we have the bandwidth to properly grow, we'll do it. But we don't, we're not hell bent on massive growth numbers. I think we'll always stay a middle market lender, and we'll take our shots on some equity deals that we're convicted about and excited about. And so I think it's just more of the same with kind of controlled growth when and where it makes sense.
Cool. Rocky, this has been awesome. Thanks for coming, man.
Yeah, it's good to be here. Appreciate the invite.
Yep.
Fun to talk to you.